With over 8 million members and consistent double-digit revenue growth, SoFi is transforming personal finance. In this analysis, we'll break down its financial performance, key risks, and future outlook. Is SoFi a true disruptor ready to reshape personal finance? Or is it an overhyped stock waiting to disappoint investors? Let's find out. First, a quick refresher. SoFi started as a student loan refinancing platform, but has expanded into personal loans, credit cards, brokerage services, cryptocurrency investing, and even offering banking services after acquiring a national bank charter. Basically, they want to become a one-stop shop for all your money needs, what they call the financial super app. That vision has attracted a lot of attention and, of course, a lot of debate. Let's look at the numbers. In their most recent earnings, revenue was $555 million, up around 37% year over year. Adjusted EBITDA came in at $88 million, positive again. Memberships, over 8 million users and growing. Banking deposits, $20 billion, showing trust in their platform. SoFi has been aggressively growing revenue and users, but they're still posting GAAP net losses, though losses are narrowing over time. This is important. Investors are betting on growth and eventual profitability. Here are the key reasons bulls love SoFi. First, there's a huge total addressable market. Personal finance is a multi-trillion-dollar industry ripe for disruption. Second, the bank charter advantage. Owning a bank allows SoFi to fund loans at lower costs compared to fintech competitors relying on third-party banks. Third, cross-selling power. Once you're in the ecosystem, SoFi tries to cross-sell other products, boosting revenue per customer. And finally, brand appeal. Millennials and Gen Z prefer app-based, digital-first banking experiences. But there are also some serious risks to consider. Profitability still isn't guaranteed. Even with strong revenue growth, SoFi has struggled to post consistent net profits. The interest rate environment matters. Higher rates can squeeze margins on lending products and dampen borrowing demand. There's also fierce competition. Traditional banks and fintech giants like Square, PayPal, and Robinhood are all fighting for the same customers. And then, there's valuation volatility. At one point, SoFi was trading above $20 per share. Recently, it's been much lower. That tells you how sentiment can swing. Analyst price targets for SoFi are all over the place, ranging roughly between $6 and $14. Some see SoFi as fairly valued, considering growth and banking advantages. Others think it's still too speculative for this market. Remember, valuation is tricky for high-growth companies because traditional metrics like PE ratios don't always apply when they're reinvesting heavily. So, is SoFi a buy, hold, or avoid? If you believe in the fintech revolution and are comfortable with volatility, SoFi could be an interesting long-term play. But if you want predictable earnings and stability, it's probably not the right stock for you, at least not yet. Personally, I think SoFi is one to keep on your watch list, especially if they can deliver consistent profitability over the next few quarters. All right, that wraps up our SoFi analysis. What do you think? Is SoFi the future of banking or just another overhyped fintech stock? Drop your thoughts in the comments. I'd love to hear your perspective. If you found this video helpful, hit that like button and subscribe to Into the Markets for more investing insights every week. Thanks for watching, and I'll see you in the next one.